Hello everybody, welcome back to another valuation investing video, and today in this video I'm be going over Monday.com, ticker symbol MNDY, and they just had their earnings report not even a few hours ago, and as we can see the stock is reacting terribly, down almost 27% on the day. So you're going to be thinking that this company had a huge earnings miss and it's just with a terrible earnings report, but we're going to be getting into that earnings in just a few seconds. But let's go over what Monday is. Monday.com is a work management platform often described as a work OS that helps teams organize, structure, and streamline their work. It allows users to build custom workflow apps using building blocks like boards, views, charts, automations, and integrations to manage products and everyday tasks. So it's a centralized platform for teams to collaborate, track progress, and manage projects effectively. So it's kind of not really like a calendar, but it does help businesses, and just it helps people with this software to have groups work together, and it really helps them and makes it more efficient to help people get on the same page and to tell them what they're going to be doing. And with that being said, this company is a $9 billion company, and right now it traded right at its 52-week low at $175, and it got back up to 182 right now. But taking a look at the earnings report, like I said, you'd be thinking that this company did terrible, but look, revenue increased 27% year over year to $299 million, beating the analyst consensus estimates of $293.5 million. So they beat on the revenue. In the EPS, they reported $1.09, exceeding the consensus estimate of 86 cents. So they beat on both the top and bottom line, and their operating cash flow for quarter two totaled $66.8 million, with an adjusted free cash flow of $64.1 million. So also for the third quarter, with their guidance, the company sees revenue between $311 and $313 million. So it was almost in line with analysts. That was the only kind of bad part about this earnings. It was slightly less than what expected, but I think what was expected was about $313 million. It was off maybe by $1 million. And then the big thing I think for this drop is because the CEO actually said on the earnings call that we are seeing some softness in the market due to the Google algorithm, and that's why the stock is tanking, and there's some uncertainty with how this could affect this company in the future. Taking a look at the revenue of Monday.com, we can see with this recent earnings of quarter three, like I said, they did beat that revenue by a decent amount, and they're all the way up here. As we can see, it's increasing every single year. This revenue is growing at a very fast pace, so this is a growing company, and it's growing pretty fast. And with the earnings per share, we can also see they basically hit right here where they once again beat analysts, and as we can see, they beat analysts by huge margins every single quarter, and maybe that's why the stock is down, because they didn't beat it by such a huge margin, and it's decreasing in the past year. Even though year over year it has increased, in the past year it's basically gone nowhere. So maybe that's why this company is trading down too, because it's pretty stagnant in the past 4 quarters basically. So with that being said, the earnings per share is stagnant, but the revenue continues to grow very fast. What the bulls have to say here is the growth initiatives with this company seems really good. MNDY, which is the ticker symbol of Monday.com, is leveraging its early CWM leadership to deliver Gen AI value, positioning it as a broader platform-driven company. So they're getting more into AI and trying to position themselves to outperform with AI. Also, they have actually outperformed all of its peers year to date, but as a result of this huge drop, that is not the case. The valuation, there has been a pullback, which has created a cheaper valuation because of its fast growth. Now, taking a look at what bears have to say for this company, we can see a lot of competitive pressure with this company. New product categories means new well-funded competitors and incumbents. New markets mean new buyer personas and sales cycles. Like right here, as I can see right here, I put this in. Some key competitors include Asana, ClickUp, Smartsheet, Rike, and Airtable, each offering unique features and strengths. So this company does have a lot of competition, which normally I like to look at companies that are having a huge moat, like Warren Buffett says, which is basically just meaning they have a big competitive advantage and nobody can really disrupt this company. But I do think that that is the biggest worry with this company, is the amount of competition. Also, guidance concerns there is for the 2026 that has become below expectations. Also, market risks. Recent recent stock weakness may reflect concerns over ongoing AI fears across application software. Now, taking a look at the financial health of Monday.com, using my 7-step stock analysis right here, these are the 7 key metrics that I like to look at for a company, which gives us a sense and quick overview of the financial health of a company. And as we can see here, we get 5 out of the 7 key metrics as check marks. The first one is the PE ratio is greater than 0, meaning it's a profitable company. But I would like to add that this is a pretty high PE ratio, especially compared to the stock market, where the stock market trades at about a 25 PE ratio. So compared to the market, this is a very high valuation, especially for a company. Although it's growing pretty fast, it's not growing insanely fast compared to the market. Also, for the forward P ratio, this is an X because it is greater than 30, meaning you're going to be paying actually $64 of $1 of future earnings per share. So this is a pretty hefty valuation, especially compared to the market. This is almost 3 times the stock market right now, so it's pretty high valuation. But that doesn't give us the big picture of this company, and it doesn't mean that it's necessarily overvalued, because taking a look at the revenue growth, this company is definitely outperforming the S&P 500 average, growing at 66% each year over the past 5 years, which the S&P revenue growth rate is anywhere from high single digits to low double digits, and this is definitely outperforming the S&P 500, so that's good in the sense that the sales of the company is growing. Also, the earnings per share is positive percentage, meaning this company has went from negative earnings per share to positive in the past 5 years. So this company has become a profitable company and still growing pretty fast, the earnings per share. And the big problem here is the shares outstanding. The shares outstanding have actually increased by 88% each year, meaning each year, one share is actually getting diluted by 1.88 times. So you're technically losing more of the ownership of a company if they increase their shares. So that's the problem with this company. They keep increasing their shares. If they increase the shares, that means you're going to actually lose a percentage ownership in the company. And with this being the case, 88% each year, they've almost increased 500%. So say you had 10 shares of this company, in reality, that 10 shares technically has gone down to less than 2. Your ownership has decreased by a crazy amount because of the dilution, but to be honest, it's not too big a worry because this is a recent company, and if they sell shares, that means they are making money, so at least they're making money off the sales. And it's not too bad because it's a recent company. And I would also like to add that this company this only was really increasing fast as of their IPO. As of lately, they've only been increasing anywhere from like 1 to 5%. So it's not too bad as of right now. This is an over-exaggerated number, but nonetheless, I don't really like dilution. The debt to equity ratio is very low at 11%. So this is really good for the balance sheet of the company. This means that they have literally 0.1 times the amount of equity in their debt. So they have a low amount of debt compared to their equity. Also, analysts expect this company to grow at 28% each year for the next 5 years for their earnings per share. So this looks very good for Monday.com. The only thing that I don't like is the shares outstanding and potentially the valuation, but nonetheless, I do like the financial health of this company, growing at a fast rate, low debt. It doesn't look too bad. Now, taking a look at my intrinsic value calculator that I created, I'm going to be using assumptions of the future for the next 5 years to determine the fair value price of Monday.com and to see if we should be buying the stock today. So with that being said, the first thing I have to assume is the annual revenue growth rate for Monday.com. Like we saw earlier, they're growing at about 66% each year. However, that's way too fast, I think, for the upcoming next 5 years. Also, year over year with their recent earnings report, they were only growing about 29%. But taking a look at what analysts expect the revenue growth to be, it's at about 18% for the next 5 years. So I think for the bear case, this company say grows at, let's do 10%. For the base case, I'm going to do 16%, and then for the bull case, say they grow at 22% each year. So with that being said, I think that this could be a pretty fair area for this company. Now, taking a look at the profit margin, let's go over to what their profit margin has been. We can see that the profit margin has been basically right around 5% for the past year or so. It's been pretty stagnant. To be honest, I feel like this company should have a much higher profit margin. So with the bear case, let's do a 5% profit margin based base case 10, for the bull case, let's say 15%. This is mainly a software company, so I don't know why this company has such a low profit margin. I mean, I do know why, because it's becoming a brand new profitable company. It's going to take some time to maximize their profits, but still, I think in the next 5 years, they could get that up to 10% on the base case. Now for the future PE ratio, I think for the future PE ratio, this company, I think if they're going to grow at 10% each year, the market right now is at about 25 PE ratio. I think they should be trading at a 25 PE ratio. For the base case, I think a 30 PE ratio is fair, and then for the bull case, 35 PE ratio. And now for the shares outstanding, I think going over to the shares outstanding right here, we can see each year they've been increasing this at about 2 to 5%, maybe 8% in the past year. Obviously, back here during their IPO, they increased their shares by a lot to dilute shareholders and get a lot of money, but now they're not really diluting too much. But I still see that they're going to dilute in the future. So with that being said, on the bear case, let's go for a dilution of, let's do 5% each year. For the base case, let's do 2.5%. And for the bull case, let's say it stays constant. With that being said, with the total annualized return, I get an average return of negative 8% each year for the base case. For the bear case, I think you'd lose 29% each year. And for the bull case, I think you can make 10%. So if you think this bull case is fair, then go ahead, go buy it. But honestly, I'm definitely staying away from MNDY.com right now. I think the problem with this company is too much competition, and I think this company could easily just be taken over right away with what they have. So thank you guys for watching this video on MNDY.com. Please subscribe, hit the like button, comment down below your feedback on this analysis. If I did anything wrong or right, please give me some feedback. Thank you guys for watching, and see ya.